In this video, I'm going to take a quick look at capital gains and losses. So when a taxpayer sells an asset, let's say stock or even a vehicle, certain types of assets, when sold, will generate capital gains and losses. Now, as we move further into this class, we'll talk in greater detail about capital gains and losses, how those things are handled. But for now, I'd like to introduce the concepts. So the first thing we need to do is we need to talk about the amount that is realized. So we're talking about an amount that is realized. All right. If you have an amount that is realized, this is going to be the amount minus any selling expenses. So say you paid commissions to a broker, to a consignment shop, etc. This is going to be the amount minus selling fees. We'll call it fees. That is your amount realized. So let's say in this example, you sold stock for $1,000. All right, so sold stock for $1,000, and there was a fee, a brokerage fee of 100. All right, to get to your amount realized, which is the first part of this lesson, you simply subtract out any selling fees, which in this case is the brokerage fee. Subtract that out. So your amount realized is going to be 900. All right, you've hammered down this concept. You're good to go. The next thing we need to talk about is what's called adjusted basis. All right, so let me explain this real quick. Adjusted basis. All right, adjusted basis is typically the cost that you have in an asset. So in the sake of this being a stock, this would be the purchase price, any basis changes, etc. We won't get into any of the complexities just yet, but let's say you had, let's see, a house. All right, so this is going to be a different example. I want to just take this up here. And let's say you had a home, you rented it for 10 years. You originally bought it for $100,000 and you depreciated it for those 10 years, and depreciation was, we're using hypothetical numbers here, $50,000. All right, so depreciation, $50,000. In order to arrive at your adjusted basis, the original basis is going to be what you paid for it on day one. That was that. The adjusted basis is going to take into account things such as depreciation. So when we ask the question, what is adjusted basis? In this example here, we've been given the facts that we bought the house for 100, depreciated 50,000 of value. The adjusted basis in this example only would be 50,000. All right, we simply subtract out depreciation, etc. For this example over here, so let's go ahead and just leave that off to the side there, because that's just an example of showing the depreciation portion of this that will come up in future examples. For this example here, let's say we bought the stock for, I don't know, let's say we paid $400 for the stock. So originally bought it, 10 years ago, paid $400 for it. I don't know why that happened. Sorry about that. Have turned a letter into an arrow. And we're just going to leave that arrow now because it wants to be there. All right, so we paid 400. All right, so in the sake of this example here, we're going to say that 400 is our adjusted basis. We subtract out that adjusted basis. This is our cost in the asset from the amount that we realize, which remember we derived here. Take that 900 minus the 400 in what we have in that asset, and we end up getting to our amount of gain realized, which in this case is going to be 500. So there are some more complexities that come along with this, but the basics of this is you have an amount that you realize, which is your total price received minus any selling fees. And then in order to arrive at your gain or loss, you must have your adjusted basis to subtract from that amount realized. And let me go ahead and do another example here. I'm going to scroll down and let me hammer out an example. The book gives a really good example. I'm going to try changing the example a touch. All right, so let's say in this particular case, we have a taxpayer. Taxpayer buys a rental property. All right. They buy a rental property. Let's say they bought it back in 2015 for $220,000. All right, so they paid $220,000. That is the original price, all right, in 2015. So they would run this in their business, renting it to different tenants from 15, 16, 17, 18, 19, all the way through current day. And they would be depreciating it along these lines. Now, for the sake of this example, we're going to simplify things, but as we move forward in the book, we'll learn that residential real estate is depreciated on a straight line basis at 27.5 years. You don't need to know this yet, but for those of you who are possibly working a little ahead, this is a little Easter egg of what's to come. All right, so for the sake of this example, we're going to say that depreciation was $20,000. Up to today. Taxpayer decides they're going to sell this house because the market is incredibly hot right now and they think that they can make a nice profit on this. And they were right. They sell it for $300,000. But there's always a catch. There are 6% selling fees that they must take into account. So we have 6% selling fees. All right, so here are the facts of our makeshift and made up case. A taxpayer buys a rental property in 2015 for $220,000. They've depreciated it over that time, and total depreciation to date is $20,000. They sell the home as of today for $300,000 with 6% selling fees. So the first number we need is going to be that amount realized. Amount realized is going to be the money they receive, which is that $300K, minus any selling fees. So 6% of 300,000 is 18,000. All right. All right, so they subtract out that 300 from 18, or I'm sorry, that 18 from the 300,000. We're going to use the handy dandy calculator. It's still early. So we're looking at an amount realized of 282,000. I'll bring that back over here. All right, so the amount realized here in this particular case is 282,000. The amount of adjusted basis is going to be the selling price minus depreciation. So that is going to be, in this case, $220,000 minus that $20,000 of depreciation. So we have the adjusted basis equals that 220,000 minus that 20,000 equals 200. So we have a adjusted basis of 200,000 right here. All right, that's how that's derived. And then you take that 200,000 of adjusted basis and you subtract it from the amount realized. So you take that 282,000 from here. You subtract out that 200,000, and what you're left with is an $82,000 capital gain. How we handle the taxes on this, we'll talk about that next.